Welcome back to the Stocked Up Show. In this video, we're going to be talking about one of the most popular and controversial stocks in the entire market, and that's Tesla. A lot of you guys probably are going to disagree with a lot of things we say in this video, and that's okay, but we're going to tell what we see with Tesla exactly how we see it. So we might offend some people, but hey, we're just going to tell the truth. So, Hunter, as I said, Tesla is one of the most controversial stocks out there. It's trading at a very aggressive valuation, and I feel like there's only two types of people when it comes down to Tesla. There's people that say, you know what, Tesla's at $1,000 a share right now, and in 5 years it's going to be at $4,000 or some other crazy high number. And on the other hand, we have many people out there, kind of including us, that say, you know what, this valuation's just not worth it. So tell me your thoughts on Tesla stock.
Yeah, I think it's just that. It's not worth it for me. The growth that they would have to justify a future even higher valuation is really high. Like, they're going to grow into this valuation, but then you don't know what the growth rate's going to be after that, and if it makes sense, and you lost all that time where the stock price could be increasing with the value, as the fundamentals. So if you have bought something in overpriced stock, like an overpriced company, and you have to wait for the fundamentals to catch up to it, and the stock price doesn't move, you have to make up for that lost growth in the future to outperform the market. And when you do overpay, you also have that huge downside risk. And the main way that you're going to outperform the market is not by getting huge percent returns, but it's by limiting your downside risk when the market also falls.
So basically what you're saying is it's overvalued.
Yeah, it's overvalued right now. Yep.
Gotcha. So let's say someone says, you know what, Tesla's not overvalued. Tesla and Elon are doing some amazing things, and look how the revenue has grown over the past 2, 3, 4, 5 years. This is a growing company, and it's going to explode up. What would your response be to someone like that? Because yes, Tesla's revenue has been amazing over the past 5 years especially. But does that equate to a rising stock price? And does that mean that you should buy Tesla stock? Like, why is it overvalued?
It does not equate to an increasing stock price, because you could look at basically any stock in the entire growth sector: Zoom, DraftKings, Palantir, Teladoc. They all had insane revenue growth in the past few years, but they're down a lot from their highs. So you need to pay the right price for that future revenue growth and the future profit and free cash flow.
Gotcha.
Or else you're going to get burned.
Gotcha.
Or you might not, but the chances are, the vast majority of the times you will. So it's just not worth it.
And I just want to make something clear really quickly, and I'm going to speak for myself, Hunter. Feel free to input in a second. But Elon Musk is a badass. He's a beast. He's done amazing things for Tesla. He's changed the company around, and I'm not going to bet against him, okay? But at the same time, I'm not going to just pay any price for Tesla shares. So I just want to make that clear. Like, I love Elon. I love Tesla, the company. But I'm not going to just overpay a ton for Tesla shares just because I love Elon.
Yeah, same. I love Elon, love Tesla, love Teslas. Think he's going to do really good things for Twitter. But I'm just not going to pay today's valuation for it. And that's not to say that it's just going to tank next week or something, but it's to say that I don't think that it's worth the downside risk over the next few years, because you don't know what's going to happen in the next 5 years. If we have a recession, who is going to be buying electric vehicles? It's going to put a damper on it. And when things are trading at lofty valuations and there's one kink in the armor, you can see what happens to it if you just look at the growth stocks for the past year.
Yeah, exactly.
With rising interest rates. That's all it took, was even the mention of rising interest rates, and that was literally their peak.
Yeah, it's true. It's true. Yeah. And I like to think of Tesla kind of like this. So let's say we have a neighborhood of houses, right? And let's say the average price for the house in that neighborhood is $500,000. But there's one house that's bigger, better, and newer than all of the rest. Tesla, okay, in this example, right? Does that mean that you might pay $600,000 for that house? Maybe. Would you pay $700,000? Maybe. Would you pay $1 million? Probably not. Would you pay $10 million? Probably not. The point is to show that Tesla, in this example, while it's bigger, better, and newer than a lot of these other companies like Ford, General Motors, and Toyota, you can't just pay any price for it. Check this out. Tesla's PE ratio right now is 132. General Motors PE ratio, 6. Ford's PE ratio, 3.4. Toyota's PE ratio, 10. Tesla, 132. And then let's say someone says, you know what? That's not a fair comparison. Tesla's not a car company. Let's say you argue that, okay? Apple, PE ratio of 27. Microsoft, PE ratio of 29. Google, PE ratio of 21. Tesla, 132. So what does this mean? Either two things can happen. Either the stock price is going to fall, or the earnings are going to rise dramatically in order for these PE ratios to balance out. So it's like either stock's going to fall or earnings are going to quadruple. But even if earnings quadruple, then it's still just trading at a fair valuation. You know what I mean?
Yeah, and then that's the whole thing. Then you have gotten rid of all that upside from all that growth. Whereas it was dead money for whatever time it took that to occur. It's going to be years. And then you also risked that huge downside.
Right.
Now, if you waited until it was a fair valuation to get in, then you could have had your money in other investments that could have returned better or safer, limited less downside risk, and then moved it in when the valuation makes sense, and you'll still have upside with less downside.
Yeah.
So, and it is, I know people are like, oh, it's not a car company. Well, it is. It is. It is a car company. They have 95% of their revenue is from their automotive segment. In the future, maybe, but you have to evaluate things on how they are right now.
Yeah.
And we do take into account their future revenue projections based on other segments as well. But right now, it is a car company.
Right now, it is a car company. But to be fair, Elon is a badass, like we said, and I know that there's a lot of hype with his Tesla Optimus robot and all that stuff. And down the line, Tesla, can definitely expand into robots, like Elon was saying, and a lot of other things. But right now, it's a car company, like you said. And even if it is even if it does turn into robot company, does that mean you pay a PE of 130 for it?
No. Yeah, and you have to be conservative when you're forecasting the revenue assumptions for those segments that basically are non-existent yet. You have no idea what the margins are going to be like. You have no idea what the market's going to be like. I don't want a robot in my house. I'm sorry. I simply don't. I don't want to see one on the street. I will it up if I see it, because who knows what. I've seen enough Schwarzenegger movies to know where that's headed. So I don't want it. And I don't want to see any robots. Sorry. That's the one thing. I just don't want to see him. But everything else, yeah.
Yeah.
And when was the Cybertruck supposed to be released? I just feel like that robot is going to be farther down the line than the initial projections, because I'm pretty sure people pre-ordered the Cybertruck 2 years ago.
Yeah. That's another thing. I was just going to bring that up, and I'm very glad you did, is because, Elon, he does amazing things, right? But sometimes he's just a little bit too aggressive in the timing. I know, the Tesla Roadster was supposed to, I believe it was supposed to be produced in 2020, and it's still yet to be, produced at any high levels at all. The Cybertruck, like you said, and it's I'm sure down the line, Elon will do a great job with the robot and many other things he has in the works right now, but I just don't think it's coming as soon as everyone thinks. And it's let's say Elon is maybe a couple years too early in his projections about the robot, that will have a very significant influence on Tesla's valuation in terms of expected revenue and profits and all that stuff.
Yeah, yeah, exactly. Like all of the valuation models that hedge funds or any like fund that is valuating Tesla will put in all of their assumptions. It'll be revenue and profit from all these different segments of their business. And when you knock off, like if you were to say, oh, it's actually not going to be done by 2025, it's going to be done by 2030, well, that's a huge chunk that people were accounting for, and that drops the valuations a lot. Right off the rip. And a lot of times they'll put price targets on a stock with no time frame. And also, if they put like a price target of 1,200 on Tesla right now, and it's at 900, that's garbage. Like there's no time frame.
Yeah.
So it could be a 10-year thing, and what's that return annualized for 10 years?
Yeah,
like,
exactly.
It's just not. So take analyst estimates and price targets with a grain of salt.
Yeah, and I feel like the biggest thing, Hunter, is not to say that Tesla stock is going to crash by 90%. It's more so that it's just not worth the risk at its current valuation. For example, Tesla stock at this very second is at $891. Let's say someone has a price target of $1,300 on Tesla stock. I'm sure at some point in the future, eventually, Tesla will be worth legitimately $1,300 per share. But that might take 10 years. That might take 20 years. You know, like, we don't know. That's the thing. But what we do know is at its current valuation, with its current revenue and profit and growth, it's not worth its current valuation. It's just not, no matter which way you look at it. Whether you say it's not a car company or it is or whatever, it's not worth its current valuation.
Yeah, and another thing to keep in mind is that a lot of those projections keep share count the same.
Yeah.
And they are diluting shareholders like crazy. Mm-hmm. And it's good for them because their stock is overpriced. If they thought their company was going to be worth $6,000 in 5 years, they would be buying shares back instead of issuing them.
That's true.
They would not be issuing shares.
Yeah.
So,
yeah, that's true. That is a good point.
And when they issue shares, each share that you have access to less of the company's revenue, profit, and free cash flow because they just diluted you. There's more shares. There's more of the pizza outstanding.
Oh, gosh. But yeah, I mean, definitely a good point there. Another thing I want to talk about is just kind of how the crowd reacts to Tesla. I'm sure a lot of people are going to be roasting us in the comments down below for not even saying that Tesla stock is going to like crash by 90%. We never said anything like that, but simply by saying it's not worth its current valuation, I'm sure we're going to get roasted down below. So with that being said, I want to talk a little bit about crowd psychology. You know, history changes, or not history changes, but the world changes, but human nature doesn't really change too much, all right? There have been many speculative bubbles throughout history, whether it's with stocks, cryptocurrencies, real estate, or even tulips, like in the 1600s. I don't know if you researched that too much, but basically there was this tulip mania in the 1600s where the price of tulips went from like $10 up to $200 in a couple months, right? There have been many examples of speculative bubbles throughout history. Like I said, whether it's with tulips, real estate, cryptocurrencies, NFTs, or stocks, right? And unfortunately, the people... Most people lose in bubbles like this, right? Because unfortunately, most people are buying when it's already high. No one hears about Tesla. Tesla stock has way more attention with it right now than it had in 2018, 2017, 2016, 2015 combined. Like, you know what I mean? So most people lose in these bubble type events. Basically, in my opinion, almost all of the crowd who follows Tesla is bullish. And that is a worrying sign for me, honestly. Because like I said, in other bubbles, like the crowd loses most of the time. And I feel like this is just another one of those scenarios where everyone's kind of sucked into thinking that just like Tesla is only going to go up. Yeah.
Yeah, I've seen an uptick of it recently. Especially, well, and another thing is they blew out earnings. Like, they crushed on everything. They're lower right now than they were before earnings. If they were undervalued and they blew estimates out of the water, how did it fall?
Yeah.
How did it fall? I know it went up a little bit on earnings, but it's lower now. It's not gonna. The outlook didn't change in 2 days.
Yeah, it's true. You know, it's a tough situation. You know, because there's just so many. Like there's really two types of people when it comes to Tesla. There's people who are saying either it's gonna blast up, or people who are like, it's just not worth it. And the people who I talk with who say Tesla is going to blast to the upside, a lot of times they say, well, look what happened over the past 3 years with Tesla stock. Over the past, 3 years, Tesla went from, let's say, you can say like $90 up to $1,243, right? They say things like that. They also say things about how Elon's changing the world, which he is. They say things how their revenue's growing, how their profit's growing. But those don't equate to rising stock prices. Like, I know we talk about this a lot, not necessarily on on these videos, but how about Intel and Cisco and all these other companies from the dot-com bubble where their revenue and profit 2 to 3x'd from their dot-com levels, and the stock price is the same or lower,
Yeah. Intel, it might be lower again now, but the other day, dividend adjusted, it had just crossed its 2000 peak.
Yeah.
And Cisco, I think, is just above its 2000 peak, dividend adjusted. Without dividends, they're still, I'm pretty sure they're both still below it. And Amazon is like 23 times higher with over 200 times the revenue. 200 times.
Jeez.
And I think Microsoft didn't cross its 2000 high until 2016.
Yeah. Exactly.
Like, that is Microsoft, one of the biggest companies in the entire world, was dead money for 16 years.
And yeah,
if you had bought it in 2000.
It's crazy. It's because, it just like goes to show you that you can't just look at a company and say, oh, I think their revenue and profit are going to increase, because look what happens if you did that over the past 20 years. And another thing is, like, I'm sure some people will say, oh, it's different with Intel, it's different with Cisco, but it's not.
It's always different.
You think it is different?
No, it's always different.
Oh, yeah, exactly. It's always different. That's always the excuse. But, like, check this out with Intel. Like we said, their revenue and profit 2 to 3 times, all right, from their highest level of the dot-com bubble. Like we said, their shares are basically at the same level from 20 years ago or lower. But the problem is that, like what was I going to say? So their profit in revenue, 2 to 3x, the share prices is basically the same. And Intel was in one of the best industries you can possibly be in over the past 20 years, the semiconductor industry. On top of that, that is through one of the strongest, if not the strongest, bull runs in history. So if you can't, like, run with those two giant rocket ship catalysts, you know what I mean? Like, it goes to show you that you have to pay attention to the valuation or you're gonna get screwed over.
Yeah, and on Intel and AMD, like, I was comparing them when AMD it had a higher market cap, I'm pretty sure, like almost the exact same market cap as Intel. And I was saying, AMD's overpriced. It's not worth the downside risk. Oh, you don't understand. They're so much better than Intel. Oh, the chips are greater. Okay, well, now it's at 80.
Yeah.
And Intel's the same price.
Yeah.
So you might have thought you had greater upside. You didn't. However, the downside is where you're going to lose to the market, because you are going to get crushed when you buy an entire portfolio of overpriced companies. Just because the companies could be fantastic companies, they could have great services or products or anything. If you overpay across a portfolio, you are going to get wiped out, and you're not going to come close to matching the market.
Yeah.
You would be better off putting your money in the SPY, VOO, SPLG, and learning. And then, or just waiting 10 years and seeing what happens.
Yeah.
And you're going to match the market for those 10 years. You're going to do better than you would have buying all those overpriced companies. and you're going to learn.
Yeah.
So that you could do it better in the future.
Yeah, exactly. You know, like, I know I already said this once, but I want to stress that, you know, we're not out here saying Tesla stock's going to fall by 90%. It's just, you can't be overpaying a ridiculous amount of money for a company just because you love Elon and because you think their revenue and profit are going to increase. Because as we've demonstrated, like, if you would have done that in the past, you would have got screwed over. You know, and like Hunter said, everyone always says, but this time it's different. But they always say that, you know, and you can't just base investing decisions based off of revenue, profit, and your opinion on the company, because that doesn't work. You know, you have to pay attention to that valuation. You know, it's so important, and a lot of people don't realize it, but hopefully this video can kind of shed some light on that, because I felt like the Intel example was perfect. You know, revenue and profit, 2 to 3x. Intel, one of the best industries you could possibly be in, and the stock market just boomed up for 20 years, with the exception of like 2008, 2009, and then the COVID crash of 2020. And there were a couple other dips here and there too, but besides that, it was basically straight up.
Yeah,
you know?
And with the two different, there's like, it's going to blast to 4,000, or like it's way undervalued, and then there are people who saying it's not worth the risk. But the difference between those two groups that I've seen is that the people who say it's not worth the risk acknowledge that it could go a lot higher. It's just not worth the risk.
Right.
And the other group is like, there is no downside risk. There is downside risk, and it could work out fine. If you do this multiple times with tons of different companies, you will have negative returns. I guarantee it.
Right. Yeah.
And like you were saying, it's different this time. It's always different this time. Everybody with the SPAC craze. Oh, it's different. Look how much money we're making. Look at my TikTok account.
Mm-hmm.
Look at them now.
Yeah.
Where are their TikTok accounts? I haven't seen one in 2 years. I haven't seen one single video about any of the SPACs in 2 years because they're all horrible. Mm-hmm. I haven't seen Chamath in an interview until the only time I saw Chamath in an interview in the past year and a half was when he said he didn't care about genocide. That was the only time.
Oh my gosh.
That was the only time I've heard him.
Yeah.
And he was the SPAC guy.
Yeah, it's true. It's true. Yeah, so I'm just like looking through some of my notes, and I just like every time I hear about people saying like, you know, Tesla's amazing, this and that, which Tesla is amazing, but I just keep being reminded about that crowd psychology. You know, I already talked about the tulip mania and all that stuff, but like even if we remember like some of the other most worshipped stocks by the crowd, right? Whether it's AMC, and look, I'm not comparing AMC to Tesla. I'm comparing how the crowd strongly backs the company without doing a complete objective valuation analysis, right? I just keep being reminded that, you know, the crowd, for the most part, loses, and it's very hard to ignore the fact that the crowd loves Tesla, you know, and most of the time the crowd loses, and there's a reason for that. So like a lot of times, like when I'm looking at stocks to buy and hold for the long term, you know, if I see everyone out there, the crowd, you know, saying I love this stock or I hate this stock, a lot of times I try and do the opposite. You know what I mean? Because the facts are the facts. Most people lose. The crowd loses most of the time. So it's like you can't be following them. And like you said, they're always going to think this time it's different, but it's probably not.
It's always different until it's not. Mm-hmm. That's what I always say. It's always different until it's not, and then they'll hate the stock, and that's usually the best time to get it.
Yeah.
They've given up.
Yeah,
they've given up. The regular person is out. They're like, this stock's dead. It's terrible.
Yeah.
Revenue and profit's still increasing, but their valuation just caught up, and then it's probably pretty good. Then you should probably look into it.
Yeah.
Yeah, but going off that, I saw somebody saying that they were, because they always like, well, look at the revenue growth. Yes, it is very high. How long are they going to keep 50% revenue growth? I saw somebody say they're going to be growing 50% for the next 10 years. No, no, they're not. That would take them to like 3.6 trillion in revenue in 10 years. Walmart is the biggest company in the entire world, I'm pretty sure, and they do 577 billion. Like revenue-wise.
Gotcha.
They're the biggest, I'm pretty sure.
Okay, revenue-wise, gotcha.
Yeah,
Gotcha.
that would be That would be so high. If they grew 50% for the next 5 years, that would make them bigger in 5 years revenue-wise than Amazon is today. And Amazon is, everybody shops on Amazon.
Mm-hmm.
They buy everything off Amazon.
Yeah, it's true. It's true. Yeah, and another thing is, like, when you were saying, like, when the average person, like, sells out, that's the buy signal. In, I want to say, like, 2000 or 2001, something like that, Amazon stock went from 113 down to 6. All right? And then it ended up going up to highs of, what is that? Let me pull it up right now. 113 down to 6, up to highs of, like, $3,700. You know, it goes to show you that, you know, like, there's just a lot of like volatility in these growth plays, you know, whether you classify Tesla as a growth play or not. But it just goes to show you that, you know, I doubt that most people or the crowd was buying Amazon when it was at $6. You know, everyone was buying back in the 2000s bubble, and all the hype was when these top stocks like Amazon were at $100 a share. You know, no one was saying now's the time to buy tech stocks, you know, back when they fell 90%.
And their revenue was still increasing when they fell 90%. Yeah. That's the thing. It wasn't like, oh, their revenue fell 90%. No, it was still increasing and it fell 90%. Mm-hmm. It's just, and nobody was buying it. If you bought it at 30 and it fell to 6, you didn't keep it.
Yeah.
I guarantee you didn't keep it.
Yeah.
There's no shot.
Yeah. True. I feel like another thing with this whole Elon Tesla Twitter situation is at the time of recording this video, Tesla is currently at $886, right? It's been a wild week, to say the least. But I feel like people are going to blame Elon buying Twitter to justify Tesla stock falling down. I feel like, let's say Tesla stock falls down to like 750 or 700 or whatever. No one's going to be like, oh, Tesla was overvalued to begin with. Everyone's going to be like, oh, Elon, you know, was selfish and he didn't dedicate himself fully to Tesla and he had to sell some Tesla stock to buy Twitter or whatever. I just feel like Elon's going to end up getting the blame with buying Twitter as the reason to justify Tesla falling. I'm making that prediction now, and we'll see 100%. What happens.
I've already seen it. I've seen hundreds of tweets. I saw Tesla falling. I was like, let's go on Twitter. Oh, it's because of Twitter, apparently. And I was like, oh, great. Yeah, that's why. Yeah, that's why. They're like, well, he had to sell shares. He didn't have to sell 10% of the company. Yeah. Like, it's just absurd.
Yeah.
I think he would have had to sell like 0.5% or 1% of his shares. Mm-hmm. That does not equate to a 10% sell-off. And they're like, well, maybe it's going to take his time away. They don't care about all his other ventures.
You're right.
Now all of a sudden, and this is not going to be as time-intensive as launching rocket ships to space. Like, Jesus.
Yeah.
It's always an excuse.
Yeah.
It's always something else and not my analysis. That's what it is.
Oh, gosh. Yeah. So, related to Tesla, do you have any other things, you know, related to Tesla stock or the valuation or anything else you want to hear?
Yeah. Let me see if I can share my screen right quick, because I'm going to go to Yahoo Finance and show their projections. Give me a second here.
Yep, so, no problem.
Share this screen right here.
All right. Looks like it's loading up right now. Let's see.
I don't know who I got to suck for it to load.
Yeah.
But
taking its sweet time.
Yeah.
All right. There we go.
Perfect. So this is their EPS, their average EPS for next year, 15.55 on 27 analysis. I'm gonna give them. I'm a very, very nice guy. $18 per share. Very, very nice. Very, very nice of me. Okay. You multiply that by a PE ratio. People are gonna be like, oh, well, the earnings are gonna get increased, so their PE ratio is gonna come down. Yes, that's how it works. Okay. Let's say they went to a 35 PE. $630 a share. That's next year.
Yeah. Okay,
so what would it take to make it worth a buy? Oh my God. 60 PE. Yeah. And a higher average, because they're probably going to beat their revenue. I mean, they've been blowing earnings out of the water. They'll probably beat on some earnings. So I gave them 18. 60 times earnings, and it's $1,000. That's $1,000, $1,100 a share, and that's the final end price. That's not like That's not like a present value to get a percent return a year, and that's next year. So it's just not worth the downside. Like, I'm not gonna bet on a company at a $1 trillion valuation, trading at 132 times PE to stay afloat and trade at above a 60 for a decent percent return in 1 year. That's not worth it.
Yeah.
So,
yeah,
they contract. Multiples contract. Earning or revenue and earnings growth cannot stay so elevated for such a long period of time. And when it falls, or even if it gets cut a little bit, that takes so much out of the valuation. Well, for example, if instead of 18, which I gave them, let's just do the 15 times 60, the 15.55. 933. It's way lower. So a slight drop, which is actually a big percent drop in earnings, but it just knocks so much off the valuation. And anything can happen in the future, which is why you have to be conservative with your estimates and your assumptions going forward, so that you limit your downside risk. Because if you don't limit your downside risk over long periods of time, you're going to lose to the market.
Yeah. Very true. I mean, look what happened with Netflix. Like, they were a growth company. Everyone loved them while they were growing. But when the music stopped, the stock lost 70% of its value, or whatever it is.
And I was saying, well, you probably remember because we talk about it all the time, but I was saying a long time ago how overvalued Netflix was. And then it tanked, and then, there's no way it can happen again. Happened again. That's what happens. When hyper growth stops, multiples contract. High multiples are justified through hyper growth.
Yeah.
If as soon as that stops or starts to decline, the multiples contract because that's just how it works.
Yeah, and for those of you who might be confused with this is, for example, Tesla's growing like crazy right now, and they have a price to earnings of $130. But basically what Hunter's saying is, once they stop growing like crazy, no one's going to pay a price to earnings ratio of 130. That's when it gets realistic, and they say, you know what, since they're not growing like absolutely crazy, we're not going to pay this type of PE. And they might pay a 30 PE or a 40 PE or a 50 PE or whatever it is. Maybe a 20 PE. You know what I mean? Who knows? But that's the important thing to keep in mind.
And since they're going to have so many different segments, you don't even know, well, I'm not saying you specifically, but you don't know what to compare it to value it. So you have no idea what it's going to be valued at.
Right.
Or something similar. Is it going to be valued like a tech stock? It doesn't have margins like a tech stock. Is it going to be valued like a car company? Its margins are better than a regular car company right now. So it's probably going to be somewhere in the middle.
Yeah.
And car companies, as we saw in a very inflated market, have PE of 4 and 9 and stuff like that. That's so low compared to a 132. Obviously, Tesla's growth potential is a lot higher. Oh, it's going lower. Fun. It's just you can't just throw shit at the wall and hope it sticks forever.
Yeah. True. All right. Well, do you have any other closing thoughts before we end the vid?
Well, I just put, this is if Tesla grew 35% a year, and for 5 years, this would be their revenue. 42%. And then 50% a year. This would be their final revenue. So, if you think it's going to grow 80%, which I saw on Twitter this morning, in 5 years, they're going to have $1.2 trillion in revenue. You have to look at, you can't just throw numbers out with no basis behind them because you think you're going to need numbers to back up your argument. You need to look at how ridiculously stupid they are. That is so... Watch it do it, and I'm going to look like an idiot.
Yeah.
But this is going to get clipped. I'm going to be like, on CNBC in 5 years and like, look at this idiot. But still, like, it just make sure they're reasonable. Like, does that seem reasonable? There's not a company in the world that does that. The biggest company in the world does half by revenue. Like, it's just so absurd. And, oh, man, 80% for 5 years. Come on. Okay. But, yeah, I just want to point that out. Like, look at your assumptions. If you're going to make assumptions, look at them. Because people could say it grows 80% a year for the next 5 years, but what does that mean? Maybe it doesn't sound like a lot. It is so much. It's so much. Because 80% on year 1 is a lot different than 80% return on the year 4. Like, that's a huge increase.
Yeah. Yeah. I get what you're saying. It's crazy. So, guys, let us know your thoughts on this Tesla topic. I know there's going to be a lot of differing opinions, and that's all right. Feel free to roast us. Like I said, there's going to be a lot of different opinions on it. Tesla's a very controversial stock. We love Elon. We love what he's doing for Tesla. Elon's a beast, but it doesn't mean you can just pay any price for the company. Kind of like what I talked about in the beginning of the episode. You know, like let's say you had a neighborhood of $500,000 houses, and even though if one of those houses are bigger and better and newer than every single other house, you don't just pay any price for it. Like there's a theoretical maximum that you should be paying, you know, like, and it's kind of like Tesla. Even though it's better than these other companies, you don't just pay any price. All right? Yeah. So if you like these style of videos, subscribe. It's a brand new show that me and Hunter are doing. We're going to have Tom on here sometimes too and other guests. But if you like it, make sure to subscribe. Let us know in the comments down below. Like I said, help us out. Let us know your thoughts. If you disagree, that's fine. Besides that, thank you guys so much for watching.